All right, let's get straight into it. All right, so um, basically, we're gonna go through learning accounting. Um, this is going to be useful for anybody looking into any sort of finance role, whether that be investment banking, private equity, etc. Um, these are all like fundamental concepts that you need to understand to help you prepare for your interviews and just for the profession as a whole. I'm currently a incoming sophomore, trying to get ready for this year's investment banking recruiting cycle, and so I'm just trying to learn all this stuff myself. I'm no expert, but as I said, yeah, I'm just trying to learn, and I think the best way to really solidify my understanding of everything is to just try and teach it to others. So that's kind of the whole point of this. And yeah, let's jump straight into it. Okay, so what is accounting? Its importance. These are kind of the next couple of pages are kind of redundant and not very important. Just just good to get a brief overview of and kind of just have in the back of your mind. So what is accounting? And you'll see that most of what's in my notes is very kind of just not super organized, but not very disorganized either, but kind of just a very condensed version of what's going to be written word for word in the Wall Street Prep where I was learning this, or the Breaking into Wall Street 400 question guide, which are two great resources to also help you learn this. I'll go very much in depth and have a lot of good questions at the end. And yeah, so what is accounting? It's a bunch of rules used for measuring a company's financial performance. And it's important for investors, lenders, and it tries to standardize financial information. Let's see if I can navigate how to do this with screen mirrored iPad as well. Because it won't let me scroll. I guess I'll just have to scroll using the mouse. All right. So, some basic accounting principles. These assumptions aren't really important. Forget about them. Don't write them down. Assumption 4, companies are required to file annual and interim reports, we'll get into. All the rest of it kind of just you can disregard. Don't worry about this stuff. So for principle 2 and 3, this is actually important. Accrual accounting. So this term right here dictates company's timing and recording its revenues and expenses. So, and again, these are two important things that I would write down. So the revenue recognition. So when a company goes to record revenue, right? They've made a sale and they're going to record that revenue. That revenue can only be recorded when it's earned and measurable, not just when cash has been received. So what does that mean? If if I'm Amazon and somebody orders a book, I can't record that revenue unless that person has received the book. Even though I might have gotten the cash payment for it, that revenue can't be recorded until the person who ordered the book actually receives it. And so that is something that was a little bit tricky because in my mind, as I'm sure most of you guys are also thinking, well, why can't I just record the revenue? And I got the cash. I'm sending out the product, I got the cash. But you can't record it until it's earned and measurable, until they've actually received the physical product or service. Now, the matching principle also goes hand in hand with that, also falls under that accrual accounting concept. You cannot recognize or record these expenses until the revenue has been recorded during the same period. So again, you have the book listed for sale. You sell the book, and let's just pretend that this is a book manufactured by Amazon itself. They put the book together. They got the raw material to put the book, whatever. So the costs associated with producing said book, those expenses cannot be recorded until it can't be recorded until the revenue from that product, the revenue that that product generated, has been recognized. So again, the revenue can't be recognized until it is earned and measurable. And a byproduct of that, the matching principle, the expenses or the costs associated with that, providing that product, also can't be recognized, can't be recorded until the revenue has been. So just something to keep in mind. Now, this is kind of where I got this Amazon example from of the book, Wall Street Prep, great resource. So again, kind of right here, you can see exactly what I was talking about. The company can't record revenue until the order is shipped to the customer. You initially would think this right here, when they receive the order, is when they could record that revenue. You can't. And then it goes hand in hand with the second question: when should Amazon record the expenses? So the answer actually ends up being on 1/4/15 for both. What's highlighted in green because of accrual accounting, because of the revenue recognition and the matching principle. Okay, so this is what's highlighted in green on this part here is mainly what you're going to want to pay attention to. The rest is kind of just background knowledge that's not really going to be very helpful. But I would focus on what's in green, the revenue recognition and the matching principle, as well as historical cost. And feel free to take a screenshot of this and write it down. I feel that whenever I'm trying to learn something, writing it down really helps you remember. Whether that's writing in your own words or even just copying it down word for word, which I guess you shouldn't do when you're taking notes, but I've done that sometimes and it helps me remember and understand. So feel free to take a screenshot and then write that down on your own. Okay, financial reporting. Another kind of not really super important thing to know. You're not going to be asked about this, but it is some background knowledge. So Form 10K, it's an annual filing that companies have to produce every single year at the end of the fiscal year. And for some companies, that might not be, the January 1st to December 30th cycle. It just depends on the company. And so this Form 10K is going to include essentially a huge overview of the company's performance for that year and anything that might have happened. There's a plethora of information, all the company's accounting, any legal things that might have happened. There's going to be footnotes explaining everything that's not directly listed. We're going to talk about this later, but on an income statement, for some things might be integrated into line items. So you're not directly actually seeing what is going into that line item. There'll be footnotes explaining all of that. So it's at the end of the year. Then there's the 10Q, which is a quarterly filing. So it's essentially a more condensed version of the 10K, and it's done every 3 months, every quarter. And then the SK, when there's a big event that happens, companies will, they'll file that. Not really important. Again, there's the S1 when a company goes public. All this stuff is just background knowledge. Don't worry about it, but it is good to just have an idea of. Don't need this. Actually, being able to read this, if you're able to go in and read a 10K, you're going to be golden in terms of understanding the accounting portion of these interviews. So that is like the end goal basically, and we'll get back to that. Okay, so now getting to the meat and potatoes of this video. Basically, I'm gonna go over all the different sections of the Breaking into Wall Street guide / Wall Street prep, and I'm going to divide it into subsections. So today we'll be going over accounting as well as there'll be 3 or maybe 4 different videos on accounting, which is one section, and then within accounting today we're going to start with the income statement. So, what is the income statement? It is a financial report that depicts the operating performance of a company over a specific period of time. It's important because it facilitates the analysis of a company's growth prospects, cost structure, and profitability. So, what does kind of all this nonsense mean? The income statement gives you an overview of a company's profitability over a specific period of time. Usually it's a year, right? So, financial report that depicts operating blah, 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 blah. Just for now, you can memorize a fancy definition. You want to sound fancy, but at a baseline level, the income statement is an overview of a company's profitability over a specific period of time. Okay. And so the income statement, right? Basically, add a new page. So think of it like this. You got this. Okay. Pass off. You got this thing. Income statement. All right. Brilliant. This is your income statement. It is literally a piece of information with a bunch of items on it. Wow, my handwriting is dog shit. So it's literally a statement with different line items. For example, revenue. For example, cost of goods sold, and we'll get into what all that means. I just think that had I been given some sort of visual representation of this before learning like all the weeds, it'd be helpful. So that's what I'm doing. So it's just think of it as like a document with these different line items. Line items are what make up the income statement. One of those is going to be revenue, cost of goods sold. As I said, we'll get into that. And basically, you're going to have a dollar amount for each of these. And again, it's going to show you once you do all the math. It's really just adding, subtracting, some division when it comes to depreciation, which we'll talk about. And then you end up with your last thing, net income. So all these different line items and all their different values, all their different amounts get you to net income. And we'll talk about that in a second. Delete this. Okay. So as I was just explaining, the income statement is made up of these different line items. And so we'll start off with the first one, revenue. So revenue can be described as a total dollar payment for goods and services that are that are credited to an income statement over a particular period of time. So revenue, how much are you bringing in over this specific period of time for the goods and services that you are providing, while following the revenue recognition principle. You're only recording these revenues once the product or service has been delivered. So that's what revenue is. You're selling something, a product or a service, while following the revenue recognition principle. The revenue that shows up on the income statement is the total dollar payment for those goods and services. Then you have cost of goods sold. This one is not tricky, but trickier to understand. So obviously, for any business, you have what you sell and the expenses that come along with that. So you have what you bring in, and then you have your expenses to, provide those goods and services. So, and take note of this, all this actually, until I say otherwise, but cost of goods sold is a company's direct cost of manufacture or procurement of a good or service that a company sells to generate revenue. So, what does all this mean? In a more simpler, condensed statement, cost of goods sold represent the costs that are directly associated with producing the product, manufacturing the product, producing the service for that a business is providing. The things that directly go into producing the product. For example, right? Let's say you are, I don't know. Let's say you make tires. Tires. Cost of goods sold for tires are going to include the rubber. So that's the raw material, right? Maybe what else? I don't know what goes into tire. The chemical glue, the machinery that shapes the tires, machine, right? All these things are going to be associated with cost of goods sold for the tires, for the tire company. What's not going to be included in cost of goods sold is what's not going to be included in cost of goods sold is the things that aren't directly associated with producing that tire. So some examples of that could be, am I blanking here? Could be the marketing director of the company that's pushing the sales for these products. I was trying to think of more of a physical thing, but just think about it. When you think of cost of goods sold, think about what directly goes into producing that product or service. So the salaries of the people, the salespeople of the tires, that's not going to be included in the cost of goods sold, right? It's going to be included in what we'll talk about after, selling general and administrative expense. By the way, these two here, these three actually, fall under OpEx, operating expenses. These are all examples of operating expenses, but they have their own specific titles because they have their own specific definitions. But going back to that tire example, the salary of the person doing the direct labor for producing those tires, the person taking it off the machine, the person putting it up on the shelf, that will be included in cost of goods sold. So anything directly associated with the production of that product is going to be included in cost of goods sold, or COGS for short. Now, this right here, gross profit is going to be represented by your revenue subtracted from your cost of goods sold, which we talked about what those two things are. But you can just have that written down, that dollar amount, that value, when you subtract your cost of goods sold from your revenue, it's going to be your gross profit, right? And so the next kind of category, the next thing that falls under the umbrella of an operating expense is SG&A. Now, if you haven't already guessed, SG&A is going to represent the costs that aren't directly associated with the production or procurement of the product or service that the company sells to generate revenue. So you can basically just end it off at the first line. So it's the operating costs that aren't directly associated with the production of the product or service that the company is providing. I kind of just restated the whole thing. That was stupid. But anyways, that's what it is, right? So what does that include? I have written down there. Wages. Again, there's a discrepancy with the wages because the wage, the salary of the person doing the manual labor to produce the tires, going back to that tire example, that expense is going to be included in cost of goods sold, right? However, the person, you know, behind the scenes who is doing the marketing on social media for these fantastic tires, they're not going to be included in of goods sold. Their salary will be included in SG&A. And so that's something to note, something to think about. Some other examples: travel. If you send an associate on a business meeting and you want to fly in first class, you're not going to be able to record that expense in COGS. It's going to go in SG&A, right? So, and I'm going to even put it up here on chat. What is the difference between SG&A and COGS? That way, you guys can get like a picture perfect definition from here. So yeah, they like to use a lemonade stand example, but use a tire company example since that's what we've been going with. Yeah. So your COGS, the cost of producing or purchasing the tires that were sold. SG&A is the cost of selling those tires and actually running the company. So the rubber, as I said, the steel, as I said, direct material, factory workers, COGS, yes, direct labor, the machinery, yes, production related, right? Packaging for tires, SG&A, the cost needed to sell the tires and operate the business, but they're not actually directly a part of producing each tire. So salespeople at the tire stores, that's going to go into SG&A. SG&A, advertising is going to go SG&A. Corporate office salaries, SG&A. HR, SG&A. All these things are going to go SG&A, right? So I like this right here. The clean way to think about it: what did it cost to make or buy the tire we sold? For COGS, SG&A, what did it cost to sell the tire and run the tire company? And then, okay, so I hope you guys can draw the distinction between those two because it's going to be important. Then we have R&D, research and development. So it's going to be a company's activities that are directed at developing new products or procedures. It's right here. So research and development is another operating expense. I believe it's usually going to be embedded in SG&A, but I will double check that. Usually embedded. Okay, I stand corrected. It's not embedded in SG&A. So basically, this is probably the easiest to understand out of the three. Research and development is exactly what it means, what it says. Research and development. For example, Apple is trying to create a new iPhone design. The research and development that goes into that, the cost associated with that, fall into that category, right? And I won't even blabber on. I know I'm very long-winded, but I'm not going to be about this. It's pretty straightforward, to the point. The research and development, those costs fall into that category. Okay. EBITDA, I don't know, I guess it got erased somehow, definition, but we're not going to go over that right now. Depreciation and amortization. This is going to be very important for us later. This right here. but I don't even think it's worth necessarily going over each of these right now. These are all different line items that are on the income statement. So if you would like just to have it maybe in the back of your mind when it does pop up again, you could write down, take a screenshot of these, pause the video, and kind of just write down these very, very short definitions that I have. That you have depreciation, amortization, other operating expenses, or operating income. So, you know, that could be, for example, and let's double check with ChatGPT. Could something in other operating expenses be a lawsuit? Yeah. Okay, perfect. Stop giving me these long answers. Don't give me super long answers right now. What is another example of other operating expenses? Insurance expense, okay. Legal fees, yeah. Office supplies, yeah. Great. Other operating expenses, which you just got the definition of. You have lawsuit settlement amount, you know, for that year, and you pay $10 million. That's going to fall under other operating expenses. You have your interest expense. If your company is issuing debt and they have to, you know, pay a monthly interest payment on that debt, that's where that expense is going to show up. Interest income, you know, it's a company's income from its cash holding and investments. If your company is the one lending money and they're receiving interest payments, it'll show up in interest income. Non-operating items, gains and losses on investments. I wouldn't look into that too much right now. Income tax. So, of course, you have to pay taxes on your income. Get into that. I'm just taking a look at this. EBIT minus net interest expense minus non-operating. Okay, that makes sense actually. EPS, earnings per share, basic earnings per share. There's also another thing where, yeah, diluted earnings per share is ran right there. It's a good metric for evaluating how well a business is performing. More nuances than just looking at, okay, what's the earnings per share? Just because, you know, a company's earnings per share high doesn't necessarily mean you should invest. But anyways, so yes, these are just for the most part other line items. These two, this tax definitely on there. These not really line items, but good to know. You can calculate these from the income statement, from the value, the number of values of things that we find on the income statement. So, and then another important thing to understand, as I said, this would come up again, and this is a little bit more repetition of what I've already explained. But as I said, I just find that writing things down repeatedly help me remember it, and when you remember something better, it's easier to understand. So, not all income is revenue, right? Revenue is money brought in from the direct core operations of the business. Okay. So, for example, when books get sold by Amazon in the specific time period and the customer receives the product and that revenue is recorded, that's income. Excuse me, that's revenue, right? However, when Amazon has payments coming in from bonds or something, that's not necessarily revenue. That's not going to be accounted for in revenue. So recall the revenue recognition principle. So on the accrual basis of accounting, it dictates that revenue must be recorded only when it's certain and measurable. Blah 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 blah. Company can't record revenue until it's earned, until the customer physically gets it, if credit card used. And then there's, this is also not as important, the sales of bundled products. What this is saying is basically that when Apple sells an iPhone, it's not just selling you the physical thing, the hardware, it's actually selling you the software as well. The software that they develop that goes along with the iPhone. I'm sure you guys always get that annoying notification that's like, yo, you gotta update your shit, and you just click later tonight, and then yeah, whatever, it'll update it for you after you jerk off and go to sleep. But yeah, that's that. Don't worry about it. It's not really important. Um, Trying to see matching principle we went over. Yeah, so this is all stuff that we got. So I'm gonna give a little bit more, shed a little bit more light onto what this is. Not all income is revenue. Explain briefly, right? We're just gonna have chat talk about this a little bit more because we already went over revenue recognition and matching principle, so we know what that is. hmm So if you take a look on the right here, it's saying that revenue is income earned from the company's main business activity, right? From core, the core operations of the business. Income is broader because it can include revenue plus money earned from other sources. And so I wanted to chat this to bring up what those other sources could be. So interest gain, earned on cash in the bank, gain from selling an old delivery truck, investment gains, a lawsuit settlement. All these things are income, but they're not revenue because this isn't from the business's core operations, right? These are external activities that are bringing in income, but they don't count as revenue. Again, we have a lovely summary. Right here is our summary. And yeah, so take a screenshot of this. What's in green is usually the most important, but all of it is pretty important as well and relevant. So take note of that. So here we're going back into cost of goods sold. As we already discussed, cost of goods sold represents the company's direct costs of producing a good or service. It's the costs that are associated with, as I just explained 10 fucking times, but I think it's good to repeat, helps you remember. It's a company's direct cost of a good or service that the company sells to bring in revenue. The chat definition was actually good. It said the cost of producing or purchasing, where is it? Try again. The direct cost of making or buying the product you sold. Give me an interview response for what COGS is. Cost of goods sold represents a direct cost associated with producing or purchasing the products a company sells. This include items like raw material, direct labor, and manufacturing costs. So this is good stuff. COGS is the direct cost of producing the goods a company sells. Right? Just repeat, rinse and repeat, write down and repeat. So We talked about SG&A, costs like marketing aren't going to be included in COGS. SG&A costs like for research and development, they're going to fall under their own category in R&D. What counts as COGS? We went over the tire example, the raw material, the machinery that's shaping the tires, etc., etc. What would fall in SG&A for the tire company? It would be the cost of marketing the tires, the tire company. Gross profit, which we glossed over a second ago, is the revenue minus cost of goods sold. So the revenue minus just that one operating expense will give you your gross profit. I don't know why it doesn't let me scroll down. The other thing. Okay. So if you look at this example, tire producer, $100 million in revenue, and you want to find the gross profit. And we know that GP, gross profit, equals revenue minus COGS, right? And so we want to find out what's the revenue, which we know is 100. Now, what are the cost of goods sold? 60 million in rubber raw material, 7 million in factory overhead. That's actually going to be included in COGS. This would be included in COGS. Direct labor would be included in COGS. However, something that is important to be noted is that you're not just going to add all these things up right now and then subtract them, even though they are cost of goods sold. Remember that the matching principle, right? You might have generated $100 million in revenue, but in the time period that we're discussing, the time period that we're looking at, only X amount of dollars was spent on the expenses that were associated with generating that revenue. So it tells us here in this example that 40 million in inventory, just right here, this kind of thing, 40 million in inventory is used in the sale, generating 100 million in revenue. Boom, cost of goods sold. And then what it tells you what's made up that 40 million. So you use 30 mil in the raw material, 5 mil in the factory overhead, 5 mil in direct labor. Office supplies, nope. We know that is going to fall in other operating expenses. 2 million on R&D. We know that's its own thing. Now, 2 million on shipping. That's directly associated with that product, with providing that product. So that 2 million is going to be included, and so you end up with your 100 mil in COGS minus your 42 mil in, your 100 mil in revenue minus your, what's it called? With your 42 million in COGS, and you're left with $58 million in gross profit. And this right here is just reiterating what I already explained. Doesn't matter how much inventory was purchased. What matters is what is used up in generating the revenue. That is super, super duper important to understand, because initially, as I thought, you would just start adding up what counts as cost of goods sold and subtracting it from the 100 million in revenue, we don't want to do that. So SG&A, looking into it a little bit more. So it's the SG&A represents the costs that are not directly associated with producing the product. Rather, they're the costs that are associated with operating the business, right? So these are all examples of what would fall in SG&A. A store lease for a retail business, salaries and commissions for salespeople, marketing and advertisements, IT people, support staff, all going to fall under SG&A. This is a little exercise which you can do about what will fall in SG&A. Salaries of administrative assistants at a tech company. It will. All supplies will. No, actually, I don't know what it has. Oh, for a steel company's corporate HQ, yes. Cost of maintenance of a factory machine, no, that is factory overhead. And those are captured in COGS. Research and development expenses, don't really need to go over again, but it's expenses that a company incurs because they are researching and developing new products, right? So those expenses will fall under that line item, will fall under their own category of R&D. Now, depreciation expense. So this is something that is going to be sometimes embedded into COGS, and we'll talk about it. This is something that's very important to understand as a baseline for, can I interpret this income statement? Can I calculate what I need to calculate to get to operating income, to get to gross profit? This is important. This is going to be important for understanding deferred taxes. This is just going to show up in a lot of different places, so it's important to understand. So depreciation is when you take the value of a fixed asset and spread it over the lifetime of that asset. So as it's written here, if the purchase is if you purchase something and that is something is going to help the company generate, revenue for multiple years, if it's going to be beneficial to the company for multiple years, you're going to depreciate. It's going to have some sort of depreciation expense, right? Even though you might pay, and I have in my example right here, even though you might pay $30 million up front, in this example for this tire pump, even though you pay it up front, you're not going to just recognize that $30 million as an expense right away up front. That's not how it works. You're going to recognize the depreciation expense. So again, depreciation, I'll have chat give us a good definition. Depreciation is the process of spreading the cost of a long-term asset over the years it's used. That's a great definition. The process. Actually, going to go ahead and write this down. The process of spreading the cost of a long-term asset over the years it's used. Perfect. So write that down, and as you go through this, it'll be easier to understand. So as I said, accrual accounting, specifically matching principle, says you spread the cost evenly over the life of the asset, so the costs are matched to the period when revenue is earned as a result of using the asset. And so that annual expense as a result of that is depreciation. And we have here that example. Command Z that. Okay, perfect. Let me go back to laser. That F1 example, F1 invests 30 M's into a tire pump, which will help the business, and the equipment is expected to be good for 10 years. And then we'll just pretend like it's completely done, so it's worthless at the end of those 10 years. So rather than recording that $30 million expense right away up front, even if you do just pay $30 million up front for that tire pump, you are going to take the value of the asset, in this case, the tire pump, 30 million, over, so divided by the years that it's used, right? Its useful life is what people tend to say, over its useful life. And in this case, it's 10 years. So you're going to be recognizing a depreciation expense of $3 million over the next 10 years. So depreciation quantifies the wear and tear, from time. Eventually the pump isn't going to be working as it once used to, through a specific decreased appreciation of the asset's historical value, the book value, as they call it, right? So the book value is what they pay for it up front. And then this is kind of important. Assets that have physical substance are otherwise known as fixed assets, but land is not considered a fixed asset. No, excuse me. Land is a fixed asset. It's a physical asset. It's a fixed asset, but you don't recognize depreciation expense on land. Just something to note. So what's going to count as something that's going to be depreciated? Building costs of a warehouse, for sure. Management compensation, no, that's a yearly expense, and you get the benefit of the 1 year that you're paying them for. Office furniture, going to be depreciated. We'll talk about it more, but that is kind of the preliminary information that you need. As I was saying, you won't see a line item specifically for depreciation on the income statement. It'll usually be embedded rather, in cost of goods sold or SG&A, depending if the asset being depreciated is tied with manufacturer or procurement, or if it's tied with something that's not directly related to producing the product. For example, like basically for the pump that is, let's just pretend that that's directly associated with the cost of producing this product from F1. We'll say that their tires or whatever, even though they don't produce tires technically, but we'll just say that. That depreciation expense will be embedded within cost of goods sold. You're not going to see it say depreciation expense. It's just going to be included. Like if your cost of goods sold is $10 million and there's depreciation expense, that is going to be included in that 10 million. Now, let's ask chat, how would depreciation be embedded in SG and A? Yeah, so some these things that are not directly tied to the business but can have, wear and tear, they can depreciate. So the office furniture, computers used by corporate employees, things of these natures, these physical assets will depreciate. And regardless of what you pay up front, you're going to recognize this depreciation expense over its useful life, over however many years it's being used, right? Okay, so as you might have already inferred, income statement profits are reduced by depreciation. But there is an important distinction to understand here. No money is actually leaving, right? The income statement doesn't care about the movement of cash. It cares about profitability. That's why we have the cash flow statement, which we will learn about later, and there will be a video for the cash flow statement. But depreciation, yes, it brings down that bottom line net income because that expense is included. It's embedded in cost of goods sold or SG&A. However, it does not reduce cash flow. These things actually get added back on the cash flow statement, which we'll talk about what that means later. But it's important to understand that it will bring down net income, but the actual cash profits of the business are not affected by depreciation. So now you might have been thinking, well, what if is there, what if there's other ways to record this depreciation expense? What if I you know, what if I want to record more depreciation this year than the next? And that'll, pose some deferred tax liabilities, which we will get into just because depreciation is tax deductible. And so you're not actually going to be paying taxes on that depreciation expense, which again is something that we'll get into later. So technically, if you record a higher depreciation that year, you'll be paying less in taxes, but it is a liability technically because you'll just be paying more the year after. Anyways, that's not important at all. Don't write down anything that I just said in the past 30 seconds, but important to understand that this 100% we want to understand through and through straight line depreciation. This is your most basic way of recording depreciation. This is how most companies are going to record their depreciation through the straight line method, which is where you take the $30 million that it costs, for the tire pump or whatever we're going to call it for the F1 example that I made up, minus the salvage value, which is essentially what is this going to be worth by the time, what is this going to be worth at the end of its useful life if I wanted to get rid of it, right? And so you would take that 30 million, the original cost, minus that salvage value. Let's say it'll be worth 10 million at the end, which is not realistic, but let's just say for the sake of numbers. So that gives you 20 million over its useful life of 10. And so you're going to record a $2 million yearly depreciation expense for 10 years. Now, there is accelerated depreciation, which, you can, let's just say you want to record just a higher percentage of that depreciation expense. Let's say instead of 2 million for that year, you want to do 4, right? Instead of doing the 10%, you want to do 20%. So most companies use straight line because it shows lower depreciation in the first years, which shows higher profitability, but it's not the only way that you can record depreciation. So just understand straight line, that's important, and then we'll get into accelerated in a bit. Now, amortization expense. This is depreciation for intangible assets, right? So as I've written down, it's the allocation of the cost of intangible assets over the number of years that the assets are expected to generate revenue for the company. So amortization is the process of spreading out the cost of an intangible asset over the useful life of that asset. So however how many years that asset is going to be, that intangible asset is going to be giving you benefit, right? You're going to take the book value of it and you're going to divide by that number of useful years. So it's lumped in with depreciation, D&A, depreciation and amortization. So the cost is not just recognized during the year as required, it's spread out over the asset's useful life. So types of intangible assets, you have patents and technology, trademarks and goodwill. Now, trademarks and goodwill are different. They're a little bit unique because they have an indefinite useful life, technically, so they're not amortized. And that's something to remember. It could show up. It's like a little trick. So remember that. It's also a non-cash expense. Like I said, it's not going to create any cash outflow, just like depreciation. It is going to be taken away on the income statement as an expense, but it's not. You're not actually losing any money. You're not. Cash isn't actually going out. But yeah, if, for example, if Google invests $30 million to get patents from a random, consulting firm, it doesn't matter that they spent $30 million up front to get that. They're going to recognize that $3 million a year for 10 years. If we're saying that this patent has a useful life of 10 years, right? So yeah, that's amortization. Again, amortization is the process of spreading out the cost of an intangible asset over its useful life. Here we go. Lovely, lovely example that we have here. What I would do is kind of cover the column 3 and column 2, read the directions, and then go through the answers and why they're the answers. So, cost of building an automotive factory, that's definitely going to be a depreciation expense. And it's going to fall into cost of goods sold. It's an automotive factory. It's going to fall directly into the cost of producing the cars. Cost of building an office to house marketing, administrative, and management staff for an automotive firm. Don't let the wording fool you, right? You might be thinking, oh, like you're getting confused with cost of goods sold, sales, SG&A, whatever. It's still a depreciation expense, but it's going to fall in other operating expenses, right? It's not going to be cost of goods sold. That to house marketing, administrative, and management, those people aren't directly involved in producing the product or service, right? So that's going to be in other operating expenses. It's not going to fall in sales, general, and administrative SG&A. Cost of salaries, it's not going to be depreciation. That's fully expensed. But pay attention to the fact that it's a cost of salaries for assembly labor at an automotive firm, right? These are the people actually forming these assembly lines and passing the materials to actually build these cars. So they're going to go in cost of goods sold. Cost of acquiring customer list, that's an intangible asset, right? You're going to have amortization expense there. That's also going to fall into other operating expenses. I'm not sure. Cost of patent filing. Now, pay attention. Pay attention to this. Cost of patent filing fees for a new windshield wiper technology internally developed. Right? Since this thing, you know, it's asking for the cost of the patent filing fees for a new windshield wiper technology that's internally developed. It's going to fall into other operating expenses. It's going to be fully expensed. I think it's because it's internally developed. You're not actually acquiring it from somebody else. Don't quote me on that. Cost of acquiring a trademark, that's not going to be in any of them. Why? We know that trademarks usually have an indefinite life, indefinite useful life. So you're not going to see any depreciation or amortization with that. And it's not going to fall into any of your operating expenses. Now, stock-based compensation. This is when instead of giving $100,000 to your employee in cash, you'll give them $80,000 in cash, and then you do 20,000 in different stock options. So it's when a company gives an employee stock, the value of that compensation, SBC is recognized as an expense in the same category as expense as the employee's regular cash comp. Right. So if this is an employee that is going to have expenses that fall under SG&A, if he's like a marketing director, it's going to that stock-based compensation is also going to fall in as an expense in SG&A on the income statement for their salary. So yeah, but if it's for this factory supervisor, it's going to fall under COGS. But bottom line, it's an expense that is going to be recognized on the in operating expenses on the income statement. And an example, as I just said, company pays salesperson 100K cash, 50K stock. You're going to recognize $150,000 expense in SG&A, right? So yeah, so a good way to remember. This is pretty good stuff. Stock-based compensation is included within the operating expense in which the employee is classified. Right? Good stuff here. Pretty self-explanatory. Let's move on. Now, other operating expenses / income. We briefly went over this before, and there's going to be two very, obvious examples of this that are important. So companies sometimes recognize expenses or income that are still technically related to operating activities, but are less typical. Right, so this could be gains or losses on the sale of a fixed asset, gains or losses from a legal settlement. Now, don't get this confused with something like interest income or interest expense. Those will get their own lines, usually net interest expense. Right, you're going to combine the two and see what's left over. Is it going to be positive? Are you bringing in, or is more going out? But there is things like other operating expenses, which I'm pretty sure we asked chat on the side here. Yeah, so an insurance expense, legal fees, repairs and maintenance, office supplies is a good one. Those are all going to fall into other operating expenses / income. Now, non-operating income and expense. So these are going to be expenses that are not directly associated with producing the product of a business or, just operating the business, the day-to-day operations of the business or company. So companies also generate income and expenses that are not tied to the core operations of their business. So everything below operating profit is not directly related to the operations of the business. That's important to know. When you're looking at income statement, everything below operating profit is not directly related to the operations of the business. So operating profit, operating income, how do you get to that line? How do you get to that? Basically, you take your revenue. We discussed what that is. Everything I'm about to say, we discussed. Revenue minus your cost of goods sold. That will give you your what? Your gross profit. And then you'll have your operating expenses, cost of goods sold, your SG&A, your R&D, your other operating expenses, your gain and loss on the truck you sold. That's going to lead you to operating income. This is the business's core profit from their operations, right? Now, you have some non-operating income and expenses as well. Now, the two most prevalent, the two most important are going to be interest expense and interest income. Interest expense, your company, your business issues debt. You got to pay interest on that debt. You're going to have to pay a monthly payment. That's going to fall under non-operating income and expenses, specifically for the interest expense. And they're usually netted together. Interest income, It's going to be a company's income from its cash holdings, from its stocks, bonds, from a savings account. If they have, like a couple $1 million, $100 million sitting in a account that's generating interest, that's income that's not tied to the core operations of the company. So it's going to be recognized as interest income, right? So a good way to understand this is that it's things that are not directly tied to the operations of the business. This could be sale of financial assets, liabilities, foreign exchange losses. It's just not tied to the core operations of the business. Rather, it's tied to the capital structure, the way you're funding your business, which is something we'll get into later. If you learn the core concepts and are moving on to this, I'll actually, it's a good idea. Actually, we'll do the core concepts. I'll do a short core concepts video. Shouldn't really spend too much time, but it does lay the foundation for what you're going to learn later, but don't look into it too deep. Your capital structure, basically, for shits and gigs, capital structure, just think debt and equity, right? Any business, when they start, they're going to need some sort of way to fund the business, to fund their operations, right? And so, mainly, the way that they're going to do this is by issuing stock, issuing shares of the company if they're public, which is going to be your equity, as well as your debt, the money that you're borrowing. And so there's going to be different debt equity splits based on the company. Your capital structure is going to be different, but that's basically the very, very dimmed down version of what that is referring to. Now, your tax expense. Nobody fucking wants to pay taxes, right? But, here we are. Taxes, taxes, taxes. So we're gonna kind of ignore this. I don't know what I just did. We're gonna kind of ignore this line here. It's not super important, but taxes. It's something important to understand is tax expenses doesn't actually equal the cash taxes paid because of the ability of companies to defer certain taxes. The tax expense companies recognize on their income statement is not equal to the actual cash taxes they have to pay for the same period. And that's what I meant when I was referring to the accelerated depreciating being a deferred tax liability. You're going to have deferred tax assets, for example, net operating loss, things that we'll get into later. But basically, on the income statement, let's just pretend your net income is $100 after everything, after your operating expenses, after your other operating, non-operating expenses, non-operating income. Your bottom line net income is $100 and the tax rate is 25. Obviously, you're going to 25%. You're obviously going to be paying $25 in income taxes, right? But that doesn't actually represent the money that is leaving, the cash that is leaving to be paid for taxes, because there are certain things that are tax deductible, meaning when you come to calculate what you will be paying for your taxes, you can actually subtract these things out, right? And you'll be left with a value that you otherwise would have been paying had these things not been tax deductible. For example, depreciation. When you add back when you're doing your cash taxes, not your book taxes referring to the taxes on the income statement, which were $25 in this case with our $100 net income, right? Which we can go ahead and write this down. $100 net income, 25%, $25. You're left with $75. Let's just say you had within that you had let's just say $50 depreciation, right? you would technically, right, you would technically add that back because the cash isn't leaving, right, to your net income. However, if you did add that back, 25% of 150 is not going to be that same $25. It's going to be more, 25%, a quarter of 150, right? Why am I blanking? 150 divided by what, 4, 3, 12, 30. Bro, am I fucking stupid? It's gonna be, yeah, no, like, give me 37.5, right? So 37.5 is what you would be paying. However, depreciation is tax deductible. So even though you're adding it back because not the cash is not leaving, there's no cash outflow. When you come to pay your taxes, it's going to get taken away again. And I'll have ChatGPT confirm that for me. If your net income was and you had a 25 tax rate, you would your book tax would be fine, right? But if you had a 100, sorry, if you had a 59, you wouldn't be paying the 37.5 income tax. I mean, well, that's what I meant. Yeah, so pre-tax income, sorry. So yeah, it's a tax shield. Instead of net income, recognize this as pre-tax income, right? Tax. Get rid of all of this. Net income, the final measure of profit, final measure of profitability on the income statement, represents income after all expenses have been paid out to the bottom line of a company's income statement. As we know, shares outstanding. I don't really know if this is too important. So basically, the rest is not super important. I think I'll go into a little bit later, actually. But for now, that is what we'll have for the accounting portion. Actually, okay, let's do it. So shares outstanding actually represent the number of shares of common stock outstanding. If shares have been issued but they get repurchased, those would be treasury stock. So one share of common stock of Apple is 1 unit of ownership in Apple. And so this is not really important, but it's good to know. Owners of these shares are entitled to vote on selection of directors and other important things in proportion with the number of shares that they own. So like 100 shares, you'd get 100 votes. Obviously, that when there's like millions of shares outstanding of a company, they're just gonna, just measure your shares as a ratio of how many are actually outstanding, and then calculate it that way. But yeah, so shares outstanding are going to be represented by the total shares that are issued minus the treasury stock, so the ones that have been repurchased. So basic shares outstanding include only the actual shareholders, while diluted shares outstanding include the effects of possibly diluted security holders that expand the share base. It makes it bigger. Your diluted shares are more than your basic shares. Now, earnings per share, as I said before, a common way that investors analyze companies' profits. You divide net income by shares outstanding, and it measures how much of the total current period profits belong to each shareholder. So there's basic and diluted earnings per share. Basic earnings per share is going to be net income divided by the basic shares outstanding. And then your diluted earnings per share is going to be net income divided by diluted shares outstanding. So this is going to look at net income, but divided by the shares that factor in option holders, preferred stockholders, etc. So it's going to give you a smaller number, right? You are dividing the same thing on top by a larger number on the bottom. So your diluted earnings per share will give you like a little bit more of an accurate representation of the company's profitability. And yeah, so nuance of earnings per share. Let me see. Perfect. Since diluted share count includes all these other income representing period. Yeah. So net income obviously represents the profits that a company generates in a period. So what do they do with those profits? They can distribute dividends, which is a portion of the company's net income that is returned to shareholders, usually on a quarterly basis in the form of cash. So if you own, let's say, 10 shares in Apple, every quarter you will, I don't know if Apple, I think Apple does provide dividends, but let's say you own shares of X company, every quarter, based on the amount of shares that you own, they will provide you with returns in the form of dividends, which are cash payments based on the amount of shares that you have and the amount that the company decides to provide in dividends. That could be, I don't know, like 12 cents per share, but however much that amount is, you're going to receive in cash for every share that you own. Well, this isn't really super important in this regard. And so these just get into the metrics that are used when analyzing business. If you're a financial analyst, these are going to be things that are very important to you when you are comparing companies that are similar. So you have your EBIT, earnings before interest and tax. So when analyzing a business, analysts compare performance of other businesses, like I just said. And since non-operating items like interest expense, interest income, and taxes are very different across even very similar businesses, analysts focus on operating income or EBIT, earning before interest and tax. So everything above operating profit income is tied to the core operations of the business, right? It's going to disregard all these non-operating expenses, all this non-operating income, right? So if you want to analyze a business's performance purely operationally, you want to see what kind of operating margins does it have using EBIT. So operating income, where are you getting that from? Revenue minus cost of goods sold minus your operating revenue minus cost of goods sold, your gross profit, and then you have your operating income, right? Minus your operating expenses. Add this together, you have your, or excuse me, I don't want to have to edit that out. So, anyways, it's just gay. not that there's anything wrong with the LGBTQ, HDMI, PS5 community. It's all love, but if my head is just getting jumbled, it's going to be your revenue minus cost of goods sold minus your operating expenses, right? What is EBIT? And EBITDA, while we're waiting for this, is earnings before interest, taxes, depreciation, amortization. This one's going to be used even more than EBIT because depreciation and amortization are a large non-cash expense for businesses with a large amount of fixed and intangible assets. And getting rid of non-cash expenses provides a more accurate picture of real profit, right? Of profit from the actual business's core operations during the year. Um, Okay, and then take a screenshot of this, go on Excel or even on paper, and you can create your own homemade income statement. And yeah, that's pretty much it for what you'll need to know. Definitely go and do more practice. This isn't meant to be in everything you need to know. It's an overview of everything you need to know. So you definitely have to do your own practice, find your own examples, play around with AI, and get the definitions that help you understand. But this is just a way to give you an overview and like help to either solidify your understanding or give you good background information and knowledge before actually going into learning these things, right? So yeah, that's going to be it. And next up will be the balance sheet part of accounting and then the cash flow statement. And that'll be it for accounting pretty much.